you know, asked me to do a training. And I love giving back or giving value. Anything that I'm learning, I try to teach it to, especially the agents. And I think EXP and our group specifically has been awesome with all the training. So in the chat box, if you don't mind, like sharing where you're from. I know a lot of us are on the Virginia side, but I know we have a few people here from, I think Pam's in Florida. So um, happy to see all you guys. So if you're in a place to put your cameras on, it's always good to see your face. But yeah, I will share a little bit about me, and then I'm going to share my screen and talk about. Can you guys see my screen? Thumbs up if you can see it.
Yes, I can see it.
We can see
All
it.
right, awesome. Cool. So if I have not met you yet, my name is Nico. I am born and raised in Montgomery County, Maryland. So I know like I said, we have a few people on the Virginia side. So I started in real estate almost 5 years ago as a realtor. I got I got licensed mainly because my dad is he was doing fix and flips, and we were handing it off to agents, and he was like, Nico, just get your license so we can kind of keep it all in house. So that's how I originally got licensed, and so I had a little bit of background on the construction and things like that. So when I started, I was really just doing the traditional um, first time home buyers, things like that. I'm a millennial. I love helping people buy their first homes. So I was helping people, the traditional way. And then 2023 is when I got into real estate investing. I had a little bit of background with my dad doing fix and flips, but I really was intrigued about learning that side of the business. I got into real estate because I wanted to learn how to own real estate myself. So since then, we scaled up. So now we have four rental properties here locally. And then my wife and I house hack, where we rent out a portion of our home to help offset our mortgage. So I really dove deep trying to learn about the investing side of real estate. I really enjoy it. And since then, Anna and I, who I'm not sure if she's on the call, but we started a podcast called the Agent to Investor podcast, where we're trying to teach agents the investing side of real estate. And then I also host a local meetup here in Maryland, the Cashflow Breakfast Club, which talks all about the investing side of real estate. So it's geared towards real estate investors, not agents in particular. But there's a few of those monthly masterminds uh, all over the country, actually. And I know there's a few. I want to say at least six in Virginia. So if you're ever interested, highly recommend meeting us in person and learning about it. Something magical about being in a room full of other real estate investors. So I did make this presentation. I'm gonna, it is a lot of information, so I'm gonna try and get through it as quickly as possible so we can have some time for Q&A at the end. But feel free to put questions in the chat. And I know Kristen's gonna, you feel free to j jump in, Kristen, if any of the questions are relevant to what I'm talking about today. So yeah, the topic is tax benefits. Talk about taxes for real estate, for W-2 earners, and really what it looks like for you. So let me see. All right. So now that we're in June, I think I made this presentation in May, but uh, how many had a client in April say, "I can't believe I just paid in taxes," or not a client, but just a family member, or a friend, and really, it's really eye-opening when it comes tax season, and you're like, "I paid that much," and to Uncle Sam, and sometimes it can be kind of heartbreaking, right? So if a client said something like that to you, you know, do you know exactly what to say back? A lot of times you you might not. So that's the goal of today, right? So what we're going to talk about today is the language, how to sound, how to know. enough to be dangerous, how to know the language without sounding like a CPA. We're never going to pretend we're CPAs. I'm not a tax expert. I just learned a little bit through my time in real estate investing and through a few trainings that we can kind of keep the conversation going, right? So that's kind of the goal today, where I'll do the disclaimer a couple times today, right? I'm not your CPA. Talk to a CPA, talk to an accountant to see how it looks like for your tax situation. And when you're talking to your clients, right, what it looks like for them, because everybody has a different tax situation. And then number two, the framework, how to spot a high W-2 prospect in your sphere right now. A lot of people will be surprised how many W-2 earners are in your sphere. So when the conversation comes up naturally around tax season, maybe you can weave it into owning real estate, how they can start owning real estate and how it can help their tax situation. I'm not a huge script guy, but I'm going to talk a little bit about how you can keep the conversations going. And then the fourth part is the mirror, right? How does it look like for your tax situation? I know owning real estate myself, owning my rental properties has really helped my tax situation, my wife and I. So we're going to talk a little bit about that. All right. So why this makes more money for you, right? So the blue ocean, right? How many investor agents do you know in your market? I'm gonna pause there, right? Like some of you, some of you know a little bit about the investing space, but I notice, at least in my experience, and it might be different in yours, a lot of agents shy away from working with investors because they may think, hey, we're gonna have to write 10 offers to get one accepted, or they're just trying to lowball a client or something like that. And I'm gonna talk about the benefits about being an investor-friendly agent. I love working with investors, not only because I am one myself, but I actually I understand it, and it can really be a fruitful relationship for them as well as you grow your agent business, right? So there's an opportunity there. And one of the main benefits, right? So a client, a traditional home buyer, they buy a home maybe every 6 to 7 years on average. So one of the benefits of working with an investor friendly is they might buy 6 to 7 a year if you find a good one, right? So 3 to 5, I'm working with a few investors that do fix and flips and things like that, and you can double dip essentially, right? If you're helping them on the buy side and they're fixing it up, and you're working with them on what you think is the best ROI for fix and flips, and then you're helping them on the resale, so you can essentially do two transactions in one. Um, Warm referrals, I notice, at least in my experience, again, I'm really doubling down and working with investors, is they run in packs, right? I've gotten a lot of referrals from my investors that are just like, hey, yeah, Nico's the guy to talk to in Montgomery County because he's actually doing it himself. He's house hacking, and they like to refer other people to you as an agent, so it can definitely be beneficial. And then property management referrals. So I don't know if anybody has a relationship with property managers in this training, but as an agent, you definitely want to start talking to them because they are the ones that are talking to landlords all the time, and having a relationship with them, saying, "Hey, I would love to help your client sell their investment property if the time comes." Those can be great referral sources as well. And then building long-term relationships. I know most of the agents here want to build uh, great relationships with their clients. We talk about nurture campaigns and things like that, but you really want to be talking to these individuals. Hey, how's that fix and flip going? Hey, how's your rental going? Are you thinking of buying another one? Are you thinking of are you thinking of selling that one? So building those relationships with these clients, is definitely a good thing. So that's why I love working with investors is it's not just one transaction every 6, 7 years. You can really build lasting relationships with them. All right. So I'm based in Montgomery County, Maryland, but I know a lot of us are in Virginia. Um, so who's sitting in your sphere that are high W-2 earners, right? Like the federal employees and the contractors, the doctors, the nurses, the healthcare administrations, IT, cybersecurity professionals, engineers, and defense, especially here closer to DC, attorneys and legal professionals. You'd be surprised at how many people in your own circle are could be a great candidate for investing in real estate. And we'll talk a little bit later about like how to weave that in when you're talking to these individuals. But all these individuals are very smart, very, some of them are very technical. And if you show them the math of what it looks like for investing in real estate, what that would look like for them as in a tax way, it could be a no-brainer for them. So to start, I want everybody in the call to start thinking about who's in your sphere that could benefit from real estate investing. Again, disclaimer, I am not a tax professional, right? So this isn't a tax class, it's a business development class. It's here to start getting you to think about your clients, your real estate investing clients, and eventually what your tax situation looks like, right? All right, so the playbook. I'm going to talk about 5 tax advantages that every agent should be able to explain, right? So when somebody brings up these things, and if you don't know, you don't have to be like an expert, but you should know how to have the conversation to keep going, right? So let's talk about deductions. These are the obvious deductions. A lot of you probably already know about these, um, especially the first two, mortgage interest and property taxes. You can deduct those from taxes, not only on your primary residence, but if you owned a uh, rental property, you can deduct these. Repairs and maintenance. So all the repairs on your investment properties, those can be deducted. If you're using a property management team, usually 10% of your monthly income. If you're doing it long term, if you're doing short term, 10 to 20% of your rental income is property management fees. So that can be a huge deduction, right? Travel to and from properties. So I know investors that invest out of their current market. So anytime you're going there to, let's just say you're doing a repair, if you are super handy and you want to do it yourself, track that, right? Track that to make sure that you can deduct that. Education. Now, this isn't a paid education today, but education on real estate that is going to help you as an investor can be deducted. Your home office and legal and accounting fees, right? So they really make it, the IRS really makes it beneficial for you to invest in real estate. So you can use all of these deductions to help, offset your income. Um, Keep it moving. All right. So I want to talk about depreciation, which is a huge one, right? Depreciation. Show of hands of it, anybody who knows what depreciation is. I know I have the definition right here, but this is a huge benefit for owning rental properties, right? So I pulled up the actual definition. I'm going to say it verbatim. So depreciation in real estate is a tax deduction that allows property owners to recover the cost of an investment property over its useful life. Even if the property's market value is rising, the IRS assumes the physical building gradually wears out and loses value, creating significant ongoing tax benefit for investors. Right? That's crazy, right? So even though the property is going up in value, you're able to take a depreciation, um, which is a huge tax benefit for real estate investors. So what does that actually look like, right? So a rental, so imagine you're working with a client. Eventually, I want you guys to start thinking about this in your own situation. But if you're working with a client and they talk about, hey, what's depreciation, right? So they buy a rental property for $400,000. So land value is not depreciable. So you can't depreciate the land. So that you're going to have to go into the tax records to see what the value of the land is. Usually they break it down, the value of the land and the actual property. So in this case, this example, $80,000 is the land value, which brings you to $320,000 building value. Some of you live in higher places. Some of you here live in higher price areas where this can be a really big value, right? The building value. And then you divide that by the IRS depreciation life. So in residential is 27.5 years. In commercial, it's 39 years. So you divide that building value by 27.5, and you have an annual deduction of 11,600 a year, which is huge. It's $11,000 that essentially is a paper loss, right? You're not losing that money, but the IRS is saying we understand that the value of the actual building is not going to be that for the year. So you divide that by 27.5. So even though the property is cash flowing, the IRS sees a loss, and both of them can be true, right? This is really where the magic happens, right? So your income, your rental income, let's just say your cash flowing, meaning your rental is more than your mortgage, interest, taxes, insurance. So you're gaining 3,600 annual cash flow while your property value is actually going up. Most of us live here in the DMV, and we know that values have gone up historically, depending on where you are, anywhere from 3 to 5%, sometimes more a year. So you're building equity that way, but on paper, the IRS is showing a loss, right? That 11,600 paper loss, and you're able to lower your taxable income, right? Your tax bill, which is pretty cool, right? So what does that mean, right? Um, Passive loss rules. So normally, the rental income, at least on long-term rentals, a year lease or 2-year leases, rental losses can offset other passive income. So they define rental income as passive. So you would only be able to offset your passive income, your rental income, with that $11,000 deduction, unless one of two things are true, right? Number one, you yourself, you qualify as a real estate professional, or your spouse, your wife, qualifies for a real estate professional status. So we're going to talk about that. This one is also a game changer. One that my wife and I actually took advantage of because I qualify for a real estate professional status. So what do you have to do to qualify for real estate professional status, right? You have to have 750 plus hours a year in real estate activities. So if you are a part-time agent, you may not qualify on that one. Um, 50% or more of your work time needs to be in real estate. Again, part-time agents may not qualify for that. And then you have to have material participation, active involvement in your rentals. So not only agents, you guys, most likely if you're full-time agents could qualify for this. Talk to your accountant to make sure that, that's accurate. But not only agents, right? Let's just say you're a property manager or um, maybe a contractor, and you're working in real estate every day. Maybe even like a loan officer, right? A loan officer. Again, talk to your accountant to see if you qualify. But if you do qualify, your rental losses can offset your W-2 or your commission income. So this is really where the magic happens, right? So what does that mean for you, right? Most agents in this room, in this chat already qualify for reps, real estate professional status, and you just don't know it, right? So your rentals could offset your commission income, which is pretty cool. All right. So number four is kind of an advanced play. You don't need to know 100% of how this works, but if somebody brings this up, usually the sophisticated investor may bring up a cost segregation and bonus depreciation. So we talked about depreciation, and you divide it by 27.5 years. Don't know why they use that number, but the IRS does residential at 27.5 years. But if you decided you wanted to do a cost segregation, you actually break the property down. So you have to pay a fee, a company to come to break down the property into 5, 7, and 15-year components. So what does that mean? We know like your fridge is not going to last 27.5 years, or basically the components of the home don't all last the same, right? So you're doing a cost segregation study to break down uh, each each part of your property and break it down into different components. And then you can use that for bonus depreciation. So you can front load all these massive deductions early and take massive losses, paper losses in the first and second year. So definitely check the rules. Right now, I think it's 100% bonus depreciation that you can take. So this is really where like big commercial investors take advantage. They do a cost segregation and they front load thousands, hundreds of thousands of their taxes, and they're able to offset all the a huge tax burden to do that. So this one's important to make sure you're keeping current because the tax law definitely changes. This isn't a political class, but right now it's 100% bonus depreciation, meaning you're able to front load 100% of the bonus depreciation, and that may change in future administrations. So what your high-end earner investor clients will eventually ask about. Again, this is an advanced play. Um, and then the last one is a 1031 tax exchange. Has anyone heard of 1031? Okay. So 1031 also, I would say it's an advance, but it's really for those who are looking to defer their taxes, right? So, they have a rental property. Let's just say they owned it for 10, 15 years and they're possibly thinking of selling. But what happens when you sell a property that you bought for 100,000 and you're selling it for 300,000, right? Uncle Sam, right? Uncle Sam's like, all right, time to get paid. When you have to pay capital gains taxes, right? So this is where instead of you taking the proceeds of the property and doing whatever you want, buy a boat, buy a Ferrari, you are deferring it, right? You're selling your property and you're buying another like kind property, um, and putting all your proceeds to the next property, and you defer and you defer and you defer, right? So it's a way that you don't have to pay those taxes. It's a great strategy for people that are looking to scale their rental property. Maybe they sell a property and continue scaling up, maybe even into commercial things. So the beauty of this is you're able to defer until you die. And I know that sounds kind of morbid, but it's a way that you're able to defer these taxes. And the IRS really has this, I guess it's a loophole or whatever, but they want you to continue investing in real estate in our nation, right? So if you're selling a property to buy another property to fix it up, or you're selling a property to continue to invest in real estate, they see that as a benefit, which is why they're allowing you to defer the taxes. So it's called a 1031 exchange. I think it's called that because it's in the tax code is 1031. These tax people aren't very creative, so that's one way that investors can take advantage, right? Now, the one last thing that I want to share about this is more for like rental properties. Fix and flips do not really qualify for the 1031 exchanges because you need to hold it as a rental. And fix and flips are considered like active. So you bought it with intentions to fix and sell it. So those wouldn't qualify. So if you're owning rental properties usually for a couple years and you plan on selling, this is where it can come in. Let me just make sure I'm doing okay on time. All right, cool. So again, to recap, five tools, one outcome, right? You want to understand operating deductions. Depreciation is a huge one. I think everyone should understand that. Understand how you can have that conversation with your high W-2 earners or anybody that's thinking about investing in real estate, because this could really be a game changer. Understand reps, real estate professional status, and how it can be beneficial to offset your actual income. So I want you guys as agents to start thinking about that. Like, what would a rental property do for, my taxes? Cost segregation and bonus depreciation, and then 1031 exchanges, right? More money in your client's pocket and maybe yours, right? So if you're working with these investors, you might be able to do multiple transactions a year. All right. So I like being transparent, right? So I'm going to share a little bit what that looks like for my Schedule E, which is the part where you're talking about your rental properties and your losses, right? So I mentioned that I have four rentals. Three of them were active last year. I just got my new rental rented actually a week ago, so super excited for that one. But I'm going to show you what it looks like in real life, right? So this right here is my tax return for last year. My wife and I, as I mentioned, so because I am a real estate professional status, my wife is a hairdresser. So we both married filed jointly taxes, however you do that. We did it together. So her income, her W-2 income could be offset by our rental losses, which is crazy, right? So think about like if you are married to a high W-2 earner, what that would look like for them. You're able to buy a property or two, and all those deductions you can take on your actual active income, which is a game changer. So line 23 is all the rents that came in from our properties. It's actually three properties, not four, because I didn't have any. I didn't have one rented until actually they move in today. So I'm going to be meeting them later today. Um, Number 23D is depreciation, which is the big one that I mentioned. We didn't do any of the cost segregation or anything like that. We just did the traditional 27.5. So it's a phantom expense. It's not one that I actually am losing money. And what that looks like for net on paper. So I don't think I mentioned this, but all the repairs and things like that I did to my property, those are also deductible property taxes, if you can see on all these line items, utilities, things like that. So my dad is a contractor, and I like finding the ugly homes in the nice neighborhoods and fixing them up and then refinancing them and keeping them as rentals. So we were able to have a negative $60,000 depreciation on my taxes, which is pretty cool. All right, section three, we'll keep it moving. The scripts, right? What do you actually say today when you're talking to your clients? Today's June 1st, so I want you guys to start thinking about who's in your sphere, right? And you can say something like this. And I know tax season was, I guess, 2 months ago, but if for whatever reason this starts coming up, right? The tax bill this year like sting? Did it hurt? Was it heartbreaking? I know a lot of people that paid a lot in taxes, right? And we always say pay taxes, right? I want to reiterate that, right? Pay as much taxes as you legally should. But those people that are W-2 earners, they're thinking about like one of my clients actually, my newest buyer was like, man, I really need to invest in real estate. I've been thinking about doing that for 2 years. And I just I can't be paying that much, right? So I'm not a CPA, but I work with a bunch of high earners who use real estate to flip the script on Uncle Sam, right? However way you want to say that to the clients, right? And once they say yes, you ask, all right, what in ballpark, like how much did you pay in federal taxes last year? and just shut up and be quiet. Have you ever owned an investment property? No, I've been thinking about it though, Nico. Like I seen your post about it. I see you, invest in real estate. Like, what would that look like for me? All right. And this one, the third one I think is really good. If you could free up 5 to 15K in taxes, what would you do with it? Oh, I'd go on vacation with my kids. Oh, I'd buy uh, my dream car or put a down payment on my new Porsche that I always wanted. Or if they're smart, I'd probably buy another investment property. So those could be the discovery questions that you're talking about when you're talking to these people, right? And this is my style. Again, every one of you guys can have different styles. Some people are more direct. I'm more like, no pressure. And I think that's why some of my clients like working with me is they're like, all right, he gets it, he's doing it. And he's ask permission based, right? No pressure. I want to work with people who want to work with me, right? So I'm not pitching you a property today. I just want to see if real estate fits your situation, right? If yes, we'll strategize. If not, no harm, no foul. Like I hope we can, if you decide to buy and sell your house the traditional way down the future, please reach out to me. But you're keeping it open-ended, right? That's a theme on a lot of these questions. Like keep it open-ended and shut up. That's one thing that I learned from I guess sales. I did sales before I became an agent is ask open questions and really just listen, right? You have two ears, one mouth. Anytime you're talking to a client or a seller or anybody in general, really, you want to ask questions, ask open-ended questions. And then use this, right? I'm not your CPA, loop one in, but here's what I see across my investor clients, right? We're never going to give tax advice. Again, we'll never give tax advice. I like using like stories, right? Oh, my other client, this is how it benefited them. Don't go into specifics about theirs, right? Don't tell them what they should do, but tell them like, hey, this is what my client, my previous client, or if you personally have experience like me, hey, this is what it looked like for me. So you can do that as well. Always cover your mind. CYA. All right. My computer glitching on me. All right. So now that it's Monday morning, right? First of the month. We always do resets, right? First of the month. This is what I'd love for each one of you guys to do, right? Identify 5 W-2 earners in your sphere, whether that's on your Facebook group, whether you use your CRM. Start looking through and think about, oh, yeah, that's my uncle's a doctor, or oh yeah, my friend works for the federal government and he's making good money. Um, and send a text opener, right? Send the opener text this week. Um, if you haven't already, get you a good accountant on your team, one that actually understands real estate investing. I love accountants, but not all of them. Just like not all agents know about investing in real estate investing, not all accountants do. So definitely find one that's on your team that can benefit, that could really take advantage of all these deductions and cost segregations, 1031s and things like that. So I know CPA on your team, but if you know a 1031 mediary, uh, that's also somebody that you'd want on your team. So if you don't have one, definitely reach out to me. I can share mine. And then one other thing that I would recommend is reading the book on tax strategies for savvy real estate investors from Amanda Hahn. So this book is from Bigger Pockets. If you haven't heard of Bigger Pockets, it's the biggest online community for real estate investors. So I encourage you guys to hop in there, just check out the forums. But this book specifically, I think I have it. Yeah, I do have it over here. It's called, yeah, the book on tax strategies. So this one is a game changer for your knowledge and for when you decide you want to invest in real estate. And then the last one is to come to Cash Flow Breakfast Club with the real client question. So Selfishly, I host a local meetup. If you're ever in Maryland, please come. We host one on the last Thursday of every month. Um, I think I saw Lance in here who has been to my Cashflow Breakfast Club a few times. And it's really about real estate investing. We have agents come there all the time, but we're really trying to break down real estate investing and how it can be beneficial for you as an agent, for you as an investor, really. So, um, and then the last thing is look at your own tax situation, right? So one thing that I've heard quite a bit is we get paid in commissions as agents, and sometimes we don't budget. And I'll actually speak on myself. Before I owned real estate, I wasn't really budgeting for taxes, right? And what happens when tax season comes? We owe a ton of money, right? You get these $10,000, $20,000 checks, and you're like, oh, great, let's go spend some money. But really, you should be obviously budgeting for taxes and things like that. But if you're thinking about maybe owning real estate yourself, what does that look like for you, right? I just showed you what it can do for you on my tax return, right? Ask your CPA before the year end, what would it look like if I bought an investment property? What price point should I be looking at, right? That alone could change your tax life, right? So all the agents in here, like this is what, if I can give you one thing out of this whole training is start thinking that way, right? If I were to own a rental property or two, what would it look like for me? All right. That was a lot. Let me see. All right, now I can see you guys. Do I have any questions? Let me see. Where's my mouse? Yeah, feel free to unmute yourself if you have any questions. Or Kristen, I don't know if you're there, if there was questions in the chat.
I have a couple questions, Nico. Can you hear me?
Yes. Hey, Pam. Good to see you.
Hey, um, first, your house hack money, you have to classify that as income, like rental income?
Yes. Yep.
Yes, I figured.
So I did. Yep. And for those who don't
Okay,
know what house hacking is when you rent out a portion of your home for, it could be, a traditional renter, or I've heard of people with, renting out a room where they do like a music studio or things like that. So any income that you're coming from your primary resident.
okay. Second question, cost segregation. You mentioned that you do that in the first 1 to 2 years. If you've owned your rental property longer than that, you can still do cost segregation, correct?
Correct. Yeah.
Okay.
So the goal from a cost segregation, let me see, is Anna on this call? We'll give her. She's not on the call. Okay. So the goal of a cost segregation is to front load as many deductions as you can. And to answer your second question, yes. So if you've owned it for some time and then you're like, I think I have a big tax bill coming up, so I want to do a cost segregation, then you can totally do it whenever you want. Now it's an expense, right? You're hiring this third party company that does that, and you need to make sure that it actually financially makes sense. So if you are expecting a big tax bill, that's when it comes out. So I'll just use Anna for example. She did one this past year, and the reason why is her and her husband were making more money, which is a great thing. But they were like, okay, then well, we have to pay more taxes. So maybe if we're able to do a cost segregation and front load a lot of these deductions, then you're able to lower your taxable income. Um, so yeah.
Okay, cool. Thank you
I
very
have a
much.
quick question. Yeah.
Yes. Hi, Suzanne.
Hi. You were talking about real estate professional status, and you said most of us don't know that we could already qualify for that. With the 750 plus years annually, does that include just your normal business?
Correct. Yeah. 750 hour. Is it days or hours? I think it's hours.
Hours, yeah.
Yeah. Um, yes. Days. There's not enough days, but hours. Yes. So you have to again talk to your accountant and make sure you qualify. But yes, if you're your agent business and you're out there doing showings, I encourage you to try and track all this. So I have a Google Calendar that shows that, I have showings, I have trainings, I'm doing this and that to, if for whatever reason you were to get audited, you have proof to show that you're actually doing it. Do track your miles through certain apps. I use an app called Stride, where it uses your GPS. So anytime I'm doing showings, I'm tracking all that. So yes,
Okay.
a lot of you guys could qualify for that.
I was led to believe, and maybe I heard her wrong by my CPA, that it was had to do with the investment properties only, and I had to prove that I did so many hours working on my investment properties. That's not the case then.
Well, you do have to actively be participating in your rental properties as well. So I
Yeah.
think let me pull up that slide. I think there was three caveats, but yes, no, 750 hours could be your agent business, anything real estate related. Yeah, right here. So active involvement in your rentals, whether you're self-managing it yourself, or you're out there doing, you know, you have to be active in it. You can't totally defer everything to property managers and things like that. So,
Okay. All right. Thank
yep,
you.
of course. Great question. Any other questions? All right, let me see in this chat. All right, Lance said, I have a student who's a physician making 200K annually from her W-2 job. She's single, does not qualify for real estate professional status, and is only interested in long-term rentals. Are there any long-term rental strategies that would provide meaningful tax benefits to or help her reduce her taxable income despite not qualifying for it? If so, have you seen it work well for other? Yeah, so real estate professional status is a way to help offset your active income. A lot of times these individuals who make 200K have great income coming in, but they're like, I'm paying a lot in taxes, right? So what would that look like if they put a $40,000 or $50,000 of that income on a long-term rental, and you're going to use it to offset the passive your rental income. So think of it that way, right? Like you're using that money to buy a rental property. Not only are you going to be building equity, but you're going to be using that to offset your passive income, your rental income. So it could still be a benefit for people that don't qualify for reps, for real estate professional status. So that's just like a bonus essentially if you are a W-2 uh, earner or a real estate professional status earner. And then to do a house hack, did you have to do permission with your homeowner's insurance provider? Yes. Yeah, so I did let them know. I did let them know actually before I had somebody in there because my whole intentions were to rent out the lower level. So I did reach out to them. And I don't think it increased my premiums. I'd have to double check. But yes, definitely reach out to them because insurance companies will always try and find ways to not cover uh, uh, if there was an emergency. So definitely reach out to them. All right, Kim. See you, Kim. Let me see any other questions in here. Don't be shy. You can unmute as well.
I don't know if this is a silly question or not, but do you think there's something like this for other company owners that aren't real estate licensed?
Um, can you explain that a little, Lisa?
Like, let's say someone owns a business, any kind of business.
Yeah,
Like if they, like, is there something that's similar to this?
to take advantage of like the benefits of owning real estate for like just
Yeah.
traditional business owners. Yeah, because I think business owners, similar to us, right? They get, I'm not going to speak for all business owners, but a lot of business owners are getting income coming in and they might not be prepping per se for when it comes tax season and they have a big tax bill, right? Kind of similar to the last question. Like if you were to buy an investment property, I think of it kind of like our agent business, and they have income coming in, and they're able to buy a property and help it offset, their passive income, which is the taxes. I mean, sorry, which is the rent. Then it could definitely be beneficial for them. Um, they don't. I know I talked about reps, real estate professional status, and that might not apply for everyone. I know a lot of people that love their W-2 or love their business, and they have no intentions of becoming realtors or property managers or things like that. So I don't, that's an added benefit, but think of it like if they were going to put some money down instead of keeping it in the bank or instead of paying less taxes, um, paying more taxes, think of it like that, right? You're buying a property, you're building equity if you're doing it correctly, obviously, and the rental income can get offset by your deductions, your depreciation, and things like that. I hope I answered that, Lisa.
I think to look into it. I'm just thinking of one client of mine who owns an equipment rental company, and he wants to buy an investment property for him and his son to live in. And if there's something like that for a business owner that's REPS, this would be
Mhm.
another great thing. And I'll look into it.
Okay.
Does that make sense? Am I saying that right?
Yeah,
For
I
other
mean,
industries, like for other industries that aren't W-2, are there other categories of this, I wonder?
yeah. Um, I guess the only way that I think of that is like again, kind of similar to us, right? We're not W-2 earners and things like that, but we do have income coming in and 1099s and things like that. So um I guess there's no like tax for the business owner, no tax class on that. But if they were to, buy these investment properties, how it could affect them would be a great, I mean, that's a great question, Lisa.
I'll look into it. It's
Okay,
another way to get people interested in buying investment properties if there's something out there like this for them.
that's right.
Thank you.
Is anybody out? Yeah, no problem. Anybody out
Hey
here?
Nico, I have a question. I think this
Yeah.
was awesome presentation, by the way, man. You packed
Hey,
the info in there. Um,
thanks, man.
this may be one for my CPA, but I've had one property for a bit that I'm thinking about doing a 1031 on and possibly cost segregating prior. Now, I had heard if you do that and you eat up all your depreciation, you have to give some of it back at the sale, even if it's 1031 or just a straight up sale. I know it's kind of a rare case. Have you heard of that happening?
Yeah. Depreciation recapture is a thing, right? So if you're
Yeah.
depreciating and you sell that property, you would have to pay it. Now, if you're thinking of doing the 1031 exchange, that's a way that and there's rules to this. I didn't go too deep into the 1031, but you have to identify a property within 45 days. You have to close on it within 180 days. So definitely talk to not only your accountant, but a 1031 specialist, intermediary that handles that. But yes, if you would, depreciation recapture is a thing, right? If you sell an investment property and you depreciate it, then that will be due when you sell, unless you do 1031 exchanges. So to answer your question about doing the cost seg beforehand, it could be beneficial. It could still be beneficial. If you really have to strategize and see if it makes sense for you to do that. If you have a big like tax bill one year, you do really great in your agent business, and you want to front load all of that. Just know that, I mean, that's not you'll have to recapture that. So when you do sell it, you know, I encourage you to look into a 1031 exchange if you plan on doing the cost seg. Again,
Gotcha. Yeah.
that might be a question for your CPA as well, and your if you need a 1031 exchange specialist, definitely reach out to me. But that's something that you'll have to game plan. That's not one thing. That's not something that you want to just pull the trigger on. Make sure that
Yeah,
you're,
absolutely. A
you're
lot of a lot of details wrapped up into those deals.
Yeah, especially now with the 1031, you have to close within 180 days. And I know that sounds like a long time in terms of like 6 years, but if you're buying on market, at least in my market, it's kind of competitive, right? So they don't care that it's competitive. The rules are rules, and you need to make sure that you follow them as well.
Thank you.
Yeah, no, great question. Any other questions? Cool. Let me do. All right. You guys still see my slides? Show of hands. Can you see it still?
Yep.
Okay, cool. All right, so just to close, right? You don't have to be an investor to serve investors, right? If you're curious about things like this, like what I'm talking about today, definitely check out our podcast. Anna and I talk about this kind of stuff all the time, right? We're trying to weave in as much as we can about the investing side to our agent community. We realize that not a lot of them understand all of this. And to be honest, I'm still learning, right? I'm a lifelong learner. I'm not going to pretend I know everything, but everything that I am learning, I'm trying to share it to our community, right? But once you have this conversation a few times, some of you guys are going to start looking at to get your own deal. And I think that's really the magic of being a realtor is you guys are doing all of these transactions all the time, right? You're helping people buy, you're helping people sell, you're helping people rent out their homes, and you need to uh, start thinking about yourself, right? Like selfishly, think about yourself, what it would look like for you to own a rental property and how you're able to you know pay legally pay less in taxes, right? And that's exactly how I started. I got into it. I was like, all right, I really want to double down and learn about it. I'm in a few investor communities and things like that. So I think hopefully that's one of the main takeaway that you guys can think about is how it would look like for you. And honestly, I know tax season just ended, but this is like the perfect time to start thinking about it, right? June 1st. All right, what it would look like if I bought a rental property by the end of the year. All right, I'm on pace to having my best year in real estate as an agent. Maybe I should just look into getting a investment property, what it would look like, down payments and things like that. A lot of us already work with already doing this, with our clients. Why not think about it for yourself? So that is all I had today. Hope you guys had fun. Good seeing you.
Absolutely. Great job. Thank you so much.
Thank you, Pamela.